In this video, I'm going to expose 5 financial products that you should never invest in. They are big wealth destroyers and companies spend crores of rupees marketing them to fool you. I'm going to tell you why you should avoid them and share smarter places where you can invest your hard-earned money instead. Let's start with a product that is designed to give you lower returns, and the worst part, most people who invest in it don't even realize that they have actually put money in it. I'm talking about ULIPs, short for unit-linked insurance plans. They're cleverly sold as a 2-in-1 combo of insurance and investments. Now that sounds like a win-win, right? Except it is absolutely not. The truth is, ULIPs don't do either of those two jobs well. They're very complicated, they are sneaky, and they benefit insurers and agents way more than they benefit you. But why actually are they so bad? The simple answer is ULIPs have a very ridiculously high fee. Now, fees when it comes to investing is very normal. And after all, when you're using a platform or availing someone's services, it's only fair that they get paid. But ULIPs take fees to another level. And before I just reveal how much they take from you, let's put that into perspective. When you invest money in a direct mutual fund, the total fee is typically between 0.5 and 0.75% per year of your investment value. And even if you go for a regular plan where you invest through an intermediary like a mutual fund agent or distributor, the fee is usually between 1 and 1.7%. For low-cost index funds, the fee can be as low as 0.06% per year of your investment value. But for ULIPs, that's a whole different story. They charge a fee that's anywhere between 8 to 10% in the first year of the money that you're investing. You didn't mishear that. You heard it right. Between 8 to 10%. So if you invest 1 lakh in a ULIP and you get a 10% return, your investment would not have grown by 10,000 to 1.1 lakhs. Instead, you would have about 1 lakh itself or even a lower amount because the entire 1 lakh does not get invested. Only between 90 and 93,000 rupees is actually invested. Where does the rest of the money go? It's all eaten up by fees, which includes mortality charges, administration fees, fund management charges, and premium allocation charges, among many other expenses. And over and above that, on the total of all these charges, there's an 18% GST that comes from your investment. Let me actually show you the breakdown of typical charges in a ULIP plan from an actual policy. So here we go, right? You're investing 1 lakh rupees and here you will see all the variety of charges that the insurance company imposes on you. So first is mortality and morbidity charges. Then they say other charges, there's an asterisk here and they ask us to refer to the next table. So if we look at again the different charges that are taken from your investment, you will notice that there's again mortality charge which stays constant. Then there is GST which is imposed, as I said, of all the total charges. There's 18% GST imposed that is taken from your investments. There's a policy admin charge, and you see how they have placed this very sneakily. They have placed all the charges here, GST here, and they have mentioned something such as FMC, which is fund management charges, but they haven't included that in the main table. They've included that later. So it just tells you that there are just so many different elements that go into how you are charged when you invest in a ULIP. If you notice the gross yield, they have to show insurance companies by regulation two different scenarios. One is 8%, one is 4% return. Here in this 8% scenario, they have said the gross yield is 8%, but the net yield is 6.19%. However, if I just scroll up, you'll see something that is again very sneaky. It says that net yield mentioned corresponds to the gross investment return on 8%. Net of all charges does not consider mortality, morbidity charges. So in this amount, when they're saying net yield, they're not even considering a big aspect here of mortality charges, which if you notice is about 1.5% of your investment value in the first year itself. And because of that, you'd see that despite getting this so-called 8% return, at the end of the first year, your total fund value is about the same that you invested. So that entire amount that would have otherwise grown is just eaten away by fees. At the same time, for every ULIP policy, and this is something that insurance agents will always tell you, that it offers you a life cover. And that is true. If you notice in the first year, you've got a 7 lakh rupee death benefit. And that 7 lakh essentially is coming from mortality and morbidity charges. So that's about 1.5 thousand rupees. And I'll show you very soon, if you go for a pure term policy, how much paying 1,500 rupees per year in premium would give you in terms of term insurance coverage, because it will blow your mind as well. I'm also going to share with you an Excel sheet that I have made, which you can access by using the link below the like button. In it, you will see a comparison of ULIPs versus mutual funds, and it will give you a very good idea as to exactly how cash flow works in both these investment instruments. So let's say you're investing 1 lakh rupees every year, and this is how it will look like in mutual funds, and this is how it will look like in ULIPs. Now, if you notice the ending balance at the end of 10 years, if you're getting a 12% return in mutual funds is 18.43 lakhs, whereas in ULIPs, it is 16.47 lakhs. Now, why is there a difference of almost 2 lakhs? That's because, as I mentioned, in the first year, that entire amount does not get invested because a lot of fees is deducted. So instead of 1 lakh getting invested, significantly lower amounts get invested. So about 92,000 here would get invested. And over that, if you get a 12% return, that will grow to about 1.02 lakhs. The effective annual fee at that point is 7.9%. This is for ULIPs. And you'll see once again that the fee reduces over a period of time, but because you have lost so much money in the initial part of your investment journey, that it really affects compounding later on. On the other hand, if you notice mutual funds, I have assumed a mutual fund fee here of 1%. This is on the higher end if it's a direct plan, usually it's lower, but we'll again go through a few scenarios. So if it's 1%, even then you end up with 18.43 lakhs. Now, one more big benefit that insurance agents would try to sell you when they're pitching you a ULIP plan is that they'll tell you that the maturity amount when you invest in a ULIP is tax-free, whereas in mutual funds that is taxable. In this table here that you see, I have calculated how much tax you'd have to pay when you're investing again in ULIPs and mutual funds. So in ULIP plans, if you're investing less than 2.5 lakhs per year across different policies, then the entire amount that you would withdraw or would redeem later on is tax-free. Because I'm investing 1 lakh here for this example, that amount will be tax-free. So if you notice the gains that I've made from investing in ULIPs are about 6.47 lakhs. There is no tax on it. So that post-tax value is 16.47, which is the same as the ending balance here. Whereas for mutual funds, I have made a gain of 8.43 lakhs, but I won't be taxed on the entire amount, because in mutual funds, if you have gains that are long-term, that is for investments that you've held for more than 1 year, then you get 1.25 lakhs of tax-free gains every year. So I've deducted 1.25 here, as you would notice. So I'll have to pay tax on 7.18 lakhs. 12.5% is the long-term capital gains tax rate, which is a tax of about 89,000. And even after tax, the gain that I make is 17, or the amount that I have at the end is 17.5 lakhs, which is again a lakh more than if I invested the same amount in ULIPs. So based on this, again, how these values are, the calculator will tell you whose value would be higher after you complete your investment journey. So it is very clear that ULIPs are draining your wealth with their exorbitant fees and charges. You are better off, in fact, keeping investments and insurance separate. So buy a term insurance plan to cover for your death. It's a very straightforward process and provides a pure life cover at a very low cost. And I'll show you in just a bit how that would look like. And for investments, you're better off choosing mutual funds or even low-cost index funds. By doing this, you ensure that more of your money is working for you and not filling up someone else's pockets. So here you'd see how much a 50 lakh cover costs for a 30-year-old man who's not a smoker. This is a cover till the age of 60. Remember, in ULIPs, the cover amount was 7 lakhs and it only gave you a cover for 10 years when that policy had not yet matured. Here, everything is multiple times higher, and the premium, if you look at it, Max Life and Bajaj Allianz, again, two solid companies, they're offering you the lowest rate of about 7,100, 200 rupees. So as you can see, getting a pure term insurance and insuring your life through it is very, very cheap, and that is how you should insure yourself, not through a ULIP. But if you've already invested in something, how do you spot that it is a ULIP plan and not a mutual fund? Now, first up, if you look at your policy documents, you'd realize that your investment has been floated by a life insurance company in the case of a ULIP plan. Secondly, if you've bought a policy through an online portal that predominantly sells insurance policies, it is definitely a ULIP. There are a lot of marketing tactics employed where ULIPs are also called funds at the end, so that creates a lot more confusion. And thirdly, if it is a mutual fund, it will have a folio number. No matter how you have invested that money, through an agent, directly from the portal, or any app like Grow or Zerodha. So look for that folio number, and if you don't find it, call up from wherever you got your investments done and ask them for a folio number. If they share a policy number instead, then you have unfortunately got a ULIP plan, because remember, every mutual fund investment you make has a folio number. ULIPs are so popular and they are missold so widely because they pay huge commissions to agents as high as 5% or even more. So if you invest 1 lakh a year, your agent could be pocketing 5,000 rupees. And if you compare that to a mutual fund where the typical commission, or as it's called, the trailer fee, is about 1% of your investment value. So it will be 1,000 rupees on an investment of 1 lakh. And that's why ULIPs are pushed so aggressively by insurance agents, by your bank, because they are great for them, but they are terrible for you. The second financial product you should avoid is digital gold. Yes, you heard it right, digital gold. It may seem convenient, but it's not at all a great investment. And by digital gold, I am not talking about gold that is held electronically through ETFs or bonds, but specifically digital gold sold through certain apps and websites. Now, one of the key reasons people opt for digital gold is the convenience of buying small amounts online. But what they don't realize is that they have hidden costs that can seriously cut into your returns. First up, there's a 3% GST that gets applied every single time you buy digital gold. This means you're starting your investment in the negative, because if you're buying 1 lakh worth of gold, only 97,000 is actually used to buy that gold and only 97,000 rupees gets invested. So you're immediately down by 3% even before starting. Then there's also something called as the buy-sell spread. This means that the platform through which you can invest in digital gold, they have a different buying price and a different selling price for gold. It's like you're buying apples in the market and you buy one apple for 100 rupees. But if you have to sell it, you can only sell it for 70 rupees. So there is right away again a loss that you make by buying and selling digital gold through a certain platform. And when it comes to digital gold, the buy-sell spread can be as high as 8%. So it's again like losing 8% of your investment value just because the buying and selling prices are different. In fact, let me share my screen and show you how the buy-sell spread works. So let's say I'm buying 10 gram of digital gold. I would have to pay 78,875 rupees. But on the other hand, if I have to sell 10 grams of digital gold, I would be getting 73,357 rupees. So you see there's a big difference between the buying and selling price. How does this actually impact you? Let's break that down in an Excel sheet. And at the same time, I'll also compare that to buying gold ETFs, which could be a good way to buy gold. So first of all, let's enter the gold selling price in this particular sheet. So there you go. Let's enter the buy price so that we have both the prices. So 78,889, right? At the same time, is there a fee or GST attached to buying digital gold? Yes, there is a 3% fee. So we'll enter 3% of this amount. So that's about 3,000 rupees. So you start the investment at 97,000 and the actual profit and loss is minus 9.8% just because of how digital gold works. On the other hand, gold ETFs also have fees, but they are not as high as 3% or, there's no buy-sell spread difference. So let's say the fee is about 1%. So we will enter this. It's actually not 1%, it's lower, but we'll consider everything because for gold ETFs, you need a demat account. So the demat account may have annual maintenance charges. Usually the gold ETF itself will charge about 0.5 to 0.65% per year. So in this case, if you notice, the profit and loss is minus 1%, and that is purely because of this 1,000 rupees that is charged as fees. And usually it would be somewhere around 700 rupees or so. So the difference would be much lower. Again, that is the difference, right? With digital gold, you start at almost minus 10% by default. Whereas in digital gold, you are starting at just about minus half to minus 1%. And that fees is going to be baked in somewhere, no matter how you buy gold. Now, until recently, the best way to invest in gold was through sovereign gold bonds or SGBs. But it appears that the government may have discontinued them, even though there has been no official announcement on this yet. And if SGBs are no longer available, then the next best option is through gold ETFs. Because with gold ETFs, you don't have to worry about purity, storage or GST. And as I said, the management fee is marginal. One more option could be gold mutual funds, but gold mutual funds underlying hold gold ETFs. So through gold mutual funds, you would pay the gold mutual fund management fee and the gold ETF management fee. So it will be again higher. But one advantage of gold mutual funds is that through them, you can have an SIP that you start in gold, which is not possible in gold ETFs. And also, if you're liking this, a sub to my channel will be sparkling for your personal finances. The third product that you should avoid investing in is a P2P loan. Now, P2P platforms often promise extremely high fixed returns, like 12% or more, which can be very tempting. Now, these P2P platforms that are short for peer-to-peer lending platforms are online marketplaces that directly connect individual lenders to individual borrowers. Now, I want you to just think about it for a second, that how are P2P platforms able to give you a 12% interest when large banks outside give you about between 6 and 8%. That's because they charge borrowers 20 to 25% to take loans. That is the interest rate, that high. But why would anyone borrow from P2P platforms when they can even get a personal loan from a bank at between 12 and 14%? Now that's because these borrowers who go to P2P platforms are considered very, very risky by banks. So essentially, banks are not willing to lend to these people because they think that if they lend to these people, they might not get the money back because they would default on their loan. So when you're investing your money in a P2P platform, your money is lent out to people who are deemed too risky by banks. Now, P2P platforms attempt to manage this risk by spreading across your investment across many borrowers. So for example, if you have invested 1 lakh in them, only about 500 to 1000 rupees would go to one borrower. So even if that borrower defaults, then because of that high interest rate that the other borrowers are paying the P2P platform, you kind of get that 12% return that the P2P platform had promised you. But the risk of this is still significant, and the RBI realized this. So until very recently, P2P platforms offered instant withdrawals, which made them seem safer. But the RBI stepped in because they realized how risky this was, and they halted this practice that P2P platforms had of offering instant withdrawals. This was anyway not allowed, but P2P platforms found creative tactics to sort of circumvent the law. And ever since RBI's moves, many users have faced difficulties withdrawing their money from these platforms. The RBI also stated that P2P platforms cannot promote P2P lending as something that can give you assured returns. And ever since this RBI crackdown in August 2024, it's suspected that onboarding of new customers on P2P lending platforms has dropped by as high as 90%. The bottom line is that P2P loans are inherently risky. So if you're looking for safer returns, stick to good old options like FDs, safe and highly rated bond mutual funds, or even small finance bank FDs. FDs, including those offered by small finance banks, are insured up to 5 lakhs under the government's depositors insurance scheme. And today, Ujjivan Small Finance Bank offers an 8.45% interest on a 1-year FD, while Jana Small Finance Bank offers 8.25, and these two banks are not paying me to take their names. As a thumb rule, remember that any fixed income instrument that offers more than 7.5 to 8.5% in today's market likely comes with more risk than it's worth. And even the stock market, if you think about it, is risky. But the stock market can recover from crisis. If it has gone down by 30%, there have been years where it has gone up by 70%. On the other hand, fixed income instruments are very hard to bounce back from if you start losing your capital. The fourth product you should not buy is a whole life term insurance plan. First up, what is exactly a whole life term insurance policy? In it, you're covered for death until the age of 100. So if you pass away any time before that, your family is guaranteed to receive the death payout. And that sounds perfect, but there are some problems with it, and I'll share them in just a bit. How does though it differ from a regular term insurance plan? In a typical regular term insurance plan, you select a coverage period. Let's say you want to be covered until the age of 60 or 70, but you can choose this entirely. And the idea behind this term insurance is very simple. If you pass away during your working years, the death claim payout covers any financial burden or responsibility like clearing loans, covering your family's living expenses, funding kids' education, and many other such things. A term insurance is meant for income replacement. So ideally, it should cover you till the time you're earning money or till your main financial responsibilities are over. Now, the problem with a whole life term insurance plan is that it covers you for way longer than you need. And that leads to three big issues. First up, high premiums. Whole life plans are much more expensive than regular term plans, and I'll show you just a bit how expensive they are. The second point is that the value of your cover amount after 40 or 50 years is very low because of inflation. and you're also paying more in premium because you're getting covered for a significantly longer period. So in that case, you'd be better off buying a regular term insurance plan and investing the difference between the two premiums in mutual funds. And thirdly, it's unnecessary coverage, because by the time you're in your 60s or 70s, you have likely paid off all your loans, you have no more financial responsibilities, and you have accumulated enough money through your investments in mutual funds, real estate, FDs, and even your provident fund account. So you don't really need the death claim money later on. Now let's break down to see actually how expensive whole life term plans are and how they can drain your finances, and whether it makes sense to, even after all of this, to go for regular plans. So again, here is the premium for a 30-year-old. If you're opting for a 5 crore cover, that covers you until the age of 70. So it's a 40-year term. And here in this case, you're paying till the age of 60. Usually I recommend people pay till the end of the policy tenure, not stop paying before that. But just to compare how it would look like against whole life term plans, we will consider until 60 right now. So in that case, you're paying between 61,000, and again, you'll see different companies offering different amounts. You'll see once again that Tata AI and Bajaj Allianz are giving amongst the best rates. So let's say we go with Bajaj Allianz, and if you notice, there's a small line here that says 6% online discount for the first year. So the renewal premium will be higher than this, and we'll just consider the renewal premium when we calculate how the two are different. And I've made an Excel sheet where I'll enter this value, and I'll also compare it against whole life later on. And I'll tell you what's also happening in this Excel sheet as well. So if you notice, this column here gets auto-populated for 30 years with a 55,000 rupee payment. Now when I enter the whole life term insurance premium, it will tell me what is the difference between the two premiums, and if that amount is invested in the market, and we'll look at different permutations here, how that would play out over the long run. So now that we have this premium, let's look at a whole life term plan and how much it would cost. In this case, once again, you will notice that Bajaj Allianz has the best rate, and once again you get a 6% online discount. So we'll enter the value without the discount, so it's a much simpler calculation. So that will be about, I'm guessing, 1,06,000. Right away, you would notice that the annual difference is 51,000, the monthly difference is 4,250. And if that 4,250 for 30 years gets invested at a 12% return, it would grow to about 1.5 crores. Then at the same time, you have a 5 crore cover. So let's say in this case, this person who's 30 years old right now passes away after 50 years. So when they're 80 years old. So in that case, what would be the real value of that 5 crores? At a inflation of 5%, let's see, it's about 43 lakhs. So again, it becomes a much smaller amount. If the inflation is higher, let's say 7%, that amount drops to almost nothing in a way compared to how much cover you had. And at the same time, let's say the person passes away at the age of 90, so 60 years later. Then the value of this 5 crore cover will be about 26 lakhs. So because of this double whammy, right, because of the high premium and effect of just investing that extra money, how much that amount would become, and also the real value of that 5 crores so far in the future, it just makes sense to again go for a regular term insurance plan and invest that difference. Now the fifth financial product you should almost always avoid is a new fund offer or an NFO. An NFO is a new mutual fund scheme that a mutual fund company has floated, and there are lots of myths surrounding NFOs. Many people think that NFOs are a wonderful deal because they have a lower NAV or a net asset value, but that is totally misleading. A low NAV doesn't mean that the mutual fund is cheap or valuable. It just shows that it is the starting point. The NFO is still buying stocks at the end of the day, and those stocks could already be expensive in the market. The price and the value of the stocks and not the NAV determines the real value of that mutual fund. People also confuse NFOs with IPOs, and many people believe that getting in early can offer significant benefits. In IPOs, we have seen tremendous amounts of listing gains in many cases where you invest for the first time, and then when the stock lists on the market, you can be up 20, 30, 50 or even 100%. In NFOs, there are no listing gains. There's no lottery system. Whoever applies for the NFO gets it. In an IPO, on the other hand, there is a lottery system where not everyone who applies is likely to get it. But what about performance? Despite all of this, do NFOs really perform well? Not really. From 1st January 2019 to 30th April, out of the 110 NFOs that were launched, 62% underperformed their benchmark or the Nifty 500 TRI index. as per a Funds India research. And if that wasn't a strong enough reason, there are 3 other ones why you should avoid NFOs. Number 1, NFOs don't have any past performance data and you're essentially betting on a new strategy without proof that it actually works. And number 2, at the same time, there are much older funds available that are investing in the same place as that NFO or using the same strategy that have gone through multiple market ups and downs, and there's data to see how these funds have performed during all those times. And finally, number 3, these NFOs are launched in hot sectors that have typically gone up quickly over the last, say, year. And by the time that NFO is launched and you invest, significant gains that would have taken place have already taken place in that particular sector or segment. The reason NFOs are so popular is because they have got large marketing budgets allocated to them and mutual fund agents are incentivized to sell them to you, and that's why there is so much craze around them. Having said all of that, there is one situation where investing in an NFO might actually make sense, and that is when an NFO has been launched that is tracking an index. So it's an index fund NFO, but even then you should only consider it if it's tracking a popular index, if it's a liquid index, if it's offered by a fund house with experience in passive investing, and there is no other similar index fund that has a longer track record that already exists in the market. With NFOs, why do you want to take on unnecessary risk when you can invest in proven funds with a strong track record? Stick to what is tried and tested, and if you want to learn more about mutual fund investing, then under the like button, you'll find a link to pre-book my course on the complete guide to mutual fund investing. You can pre-book it at a special price right now. Check it out, and if you enjoyed this video, then watch this one where I talk about SWPs, that are systematic withdrawal plans, where I talk about how you can generate income from your mutual funds.